Hi there. Welcome to another video on making accounting adjustments. And take this thing. Okay, so we are going to be making an adjustment for accrued salaries and wages in this problem. And so let's take a look at our narrative here. We have Pablo Management. They have 5 part-time employees. And those part-time employees earn $250 a day. So right now I'm going to do a little bit of math. I know I have 5 employees, and they're going to earn $250 each per day. And so that's a total of $1,250 a day for all 5 employees. So these employees are normally paid on Friday for the work that they did Monday through Friday of the same week. So today just also happens to be a Friday, and if I worked for Pablo Management as one of these employees, I would get paid today for my work on Monday, Tuesday, Wednesday, Thursday, and Friday of this week today. We are making the assumption that December 28th was a Friday, and so our employees are paid on that day. Okay, so let's go ahead and mark some days and dates in here. This is a Monday, Tuesday, Wednesday, Thursday, Friday. Oh, I do not have enough. Okay, let me pause this a moment. Okay, this looks a whole lot better. I have more space. So let's put our dates in here. Monday, Tuesday, Wednesday, Thursday, Friday. This Friday, ding, 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 this is payday. This is 12/28, they tell us. December 28th was a Friday, and our employees got paid. And then we have Saturday, Sunday, and we start the next week, Monday, Tuesday, Wednesday, Thursday, and Friday. Ding, 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 we have another payday here on Friday. So let's finish out our dates. Well, this is 12/28 here on Friday. So Saturday is 12/29. Sunday is 12/30. Monday is 12/31. Our employees are going to work that day. Tuesday is January 1, but we're closed and we're not paying our employees on that day. On Wednesday is the 3rd, Thursday, I'm sorry, is the 2nd, Thursday is the 3rd, and Friday is January 4th. Okay, so what we know is our employees, they got paid $12.50 every day. Our 5 employees, not just one. So on December 28th, we paid them for all 5 of those days. So 5 days times $12.50 per day is $62.50. So our journal entry that day would have looked like this. We would have, that's for this day, we would have debited on 12/28. We would have debited our wages expense, $62.50, and credited cash, making it go down, $62.50. Debiting the expense makes it go up. And of course, we would have had our description on it to record payment of wages for week ending 12/28. Okay, so as of 12/28, our employees are paid. Everybody's happy. Our offices are closed on Saturday and Sunday, and on 12/31, our employees are back to work. Now, 12/31 is an interesting date because on this date, we are going to need to issue a financial statement. And one of those financial statements will be our income statement. And then on that day, what we find is that our employees worked, and so they are due a total of $1,250 for that day, and we are going to issue a financial statement on that day. So the question is, when have we incurred that expense? Well, our employees have worked on that day, so we have incurred the expense right here. It's incurred. They worked, we owe them, it's our expense right at that point in time. What we know is our accounting principle says, our expense recognition principle says that expenses are recognized when they're incurred. Well, this is incurred because our 5 employees worked on that day, but they are not going to get paid on that day. Not on 12/31. They're not going to get paid until here, payday, on Friday, January 4th. So they've worked for us. We have an expense, but we don't have a transaction to record because we haven't paid them on 12/31. But we still have to record that expense because we have incurred it. So let's go ahead and record an expense for one day in 2017. One day was worked in 2017, and we're going to issue a financial statement, so we can't just ignore that expense and not record it. So I'm going to come down here. I have a journal entry, a place to do those. So on 12/31, we have to record an adjusting journal entry. And what we know is that we have one day's worth of work that our employees have worked, and that's for $12.50. So we have an expense as of 12/31, one day at $1,250. So we have our wages expense and I'm going to put in parentheses here what we are accruing. We are accruing one day at $12.50. If we were accruing for 2 days, we would be accruing $2,500. But this is only one day on 12/31. So we're going to debit that expense, $12.50, making it go up. So our expense has gone up, and when our employees work, they expect that we will pay them, and in fact we will, but we won't pay them until January 4th. So at this point in time, we have a liability. We have an amount that we owe to our employees for $1,250, and we are going to call that liability wages payable. By crediting a liability, we increase it. So we're doing the right thing. We are showing that we now have a liability that we did not have before. Why? Because our employees worked, and we're not going to pay them for another 4 days. Our journal entry description: to record accrued but unpaid wages. Actually, what I would say, let me change that. I would say, if I was going to say accrued, I would just say accrued wages. Or, there's a big or, you could say to record wage expenses incurred but not paid. So we have to record the expense because it has been incurred, and we have to record the liability because it has not been paid. We owe it. So that completes that journal entry, and we have now properly recorded the expense. So now we have another dilemma, because we are going to pay these employees on January 4th. Now, we know that this is a holiday, January 1, and they're not getting paid. But they are going to be working on Wednesday and Thursday and Friday, $12.50 each day. So on Friday, we are going to pay them for 4 days. We're going to pay them for $12.31, January 2nd, January 3rd, and January 4th. So we're going to pay them for 4 days. 4 times $12.50 is equal to $5,000. So we're going to pay them $5,000. Okay? So that's going to use our cash. No doubt about that. Well, only 3 days are an expense of this year. Only these 3 days are in this year, an expense of this year, and this day was an expense that we recorded last year. So of that $5,000, only 3 of those days, we're going to pay them for all 4, but only 3 of those days are an expense of this year. The other day was an expense last year, so we have a liability on the books for it. What liability? Wages payable. So what we need to do, since we're going to pay them on the 4th, and we're going to pay them that $5,000 in cash, we need a journal entry now to record the cash that we're going to pay. We can't just debit wage expense and credit cash for $5,000. We can't do that because we already recorded 1 day of wage expense. So if we were to do that, we would have counted that day in our expense twice. So I'm going to do the journal entry right here in this space rather than lose my work up here. So January 4th is the day that we're going to make the payment, so that's the date we're going to put on it. And, you know, I always tell you, do what you think is easiest first. What we know is that we are going to use our cash to make this payment, and so we're going to credit cash for $5,000. Right? Here's our, here's our debits are going to be here. Oops. Our debits are going to be here, and our credits are going to be here. So we're crediting cash for $5,000, making cash go down. Why? Because we are paying the employees for the 4 days that they worked this week. However, only 3 days are an expense of this year. So we are going to debit wage expense for 3 of those days at $12.50 per day, and that's $37.50. If you want to be consistent, we can also say here that we're paying 4 days times $12.50. That's how we calculated the $5,000. Remember, you are responsible for showing all of your work and all of your calculations on a test. And then our journal entry doesn't balance. We need an additional $12.50 debit in order to make our debits and credits balance, don't we? So what are we going to debit? Well, here's the thing. That 1 day that we're going to pay, our 12/31 day, we have already recorded the expense down here, and we recorded a liability for that $12.50. So once we pay this amount on Friday, do we owe it any longer? We do not. Once we pay it, we don't owe it anymore, so we need to make that liability go away. So we need to make that liability go down. So let's debit our wages payable. Wages payable is a liability, and so by debiting it, what does that do to our liability? It makes the liability go down. We credit the liability to make it go up, so we debit it to make it go down. And we need to write our description to record wages paid for the week. Okay, so that completes how to make an adjustment for wages payable or salaries payable. Remember, we can have any combination of dates. I mean, here we only had 1 day in that we had to accrue for and record the expense for, But if our employees had also worked this day on 12/30 and 12/31 and hadn't been paid for it, then we would have 2 days we needed to accrue. So it's not always going to be 1 day, it's however many days your employees have worked and provided services for which they have not been paid. And then you have to record the expense even though you're not going to pay it until the future, because we cannot wait to record an expense to a date in the future. We have to record that expense when it is incurred, and that is no more important than when we are getting ready to close our books and issue a financial statement at the close of any period. That could be a month, that could be a quarter, that could be a year. In this case, we were working with a 12/31 year end, but that could have just have been the month ended December 31st that we were working with as well. Okay, hope that helps, and there will be a problem for you to do as well. Thanks for watching.